Are you tired of owning stock in volatile markets? The stock market crashes and you lose a third of your money. Well, imagine controlling 100 shares of stock and being able to take much less of a hit and make money in both directions. Well, in this video, I'm going to show you how to utilize LEAPS options and collect monthly income against those LEAPS every single month, and eventually control those 100 shares for no cost at all. So before we get started, be sure and download the free options workshop in the link below. Also, make sure to hit like and subscribe down below. All right, guys, what are LEAPS options and why do they matter? How are they different than regular stocks? LEAPS stands for Long-Term Equity Anticipation Securities. I know it's a mouthful. They're a type of options contract with expiration dates longer than 1 year, typically up to 2 or 3 years. Unlike stocks, which can be held indefinitely, LEAPS have a set expiration date, making them a time-sensitive investment tool. What really sets LEAPS apart from owning stocks outright is their leverage. You can control 100 shares of stock with significantly less capital outlay than buying the shares outright. Now, this can work in your favor should the stock go your direction. However, you can also lose money too. LEAPS are particularly useful for investors who want to profit from long-term trends or hedge their portfolios. They offer flexibility and lower upfront costs compared to stocks, making them an attractive option for those looking to maximize returns while managing risk. So how do we generate weekly or monthly income utilizing LEAPS options? Well, I'm going to show you. We can go ahead and sell weekly or monthly short call options against our LEAPS options that we purchased. Now, this allows us to have a covered call on without having to outlay the money for the 100 shares of stock up front, which is huge. You can outlay a third or less up front and still sell the calls against it and collect weekly or monthly income. So we can profit in any direction that the market goes going forward. When the market goes up, your LEAPS call gains value as the underlying stock price increases, allowing you to benefit from long-term upward trends. Meanwhile, the short-term calls you've sold generate income even if they expire worthless or are rolled to higher strike prices. When the market goes down, while your LEAPS may lose some value temporarily, the short-term calls you've sold will likely expire worthless, allowing you to keep the premium. This offsets some of the downside risk and provides consistent cash flow weekly or monthly, every single month. Now, the real beauty of this strategy is its flexibility and adaptability. So when the market goes up, you profit on the LEAPS. What you can do is you can close out your call or close out the call and the LEAPS and just take the gain of the overall position and wait for a pullback. Or what you can do is leave a core position on, let your LEAPS go and run up, and you can roll your call out in time and up and collect additional premium. Now, on the down days, what you do is you can go ahead and close out that call position or roll it down and collect additional premium. As you get closer to the expiration date, 10, 15 days to expiration, what you can do is close that out and then roll out to the next month, up and out, and collect more premium. You're making money in both directions. Now, we talked about the downside risk management and the fact that since you are putting up less money than buying the shares outright, your potential loss should the stock price move down is much less than it would be for owning the stocks outright. So now let's talk about some of the long-term benefits. Portfolio hedging. You can use LEAPS options to hedge against market downturns by controlling assets with less capital tied up. You're also using diversification. LEAPS allow you to invest in multiple different stocks in different sectors without requiring large amounts of cash. And you can compound gains by reinvesting the income from the covered calls and rolling the LEAPS positions into new ones. So over time, you can really build some wealth. All right, let's jump into a live trade on the option trading platform. All right, guys, here we are on the Tasty Trade option trading platform. There's a link down below. There's some benefits if you join through my link. It's great for trading options and the one that I use all the time. Now, let's punch in NVDA up here in the upper left. Now, this stock right now is beaten down, but you know they are the king of AI. They've got all their chips already sold for the next couple years. So it's going to go up over time. Here's how we can take advantage of a LEAPS option and sell a short call against it and collect monthly income. So over the period of 6 months, less than 6 months, we can control 100 shares of stock without really putting out any money at all. So here's what we do. We are on the trade page and the table mode, and we're going to go out a year. Let's go out to 350 days to the March 20, 2026 option chain. Open that up. Now, calls are on the left, puts are on the right. Let's go to the 90 call, which is the 65 delta. I like to go at least 65 delta or higher. That gives you a 65% advantage of owning the LEAPS. Oh, not advantage, but a 65% simulation or duplication of owning 100 shares of stock outright. If you went to the 50, you would have a 90% duplication of owning 100 shares of stock outright. So I like to go at least 65, and as you go deeper in the money, the cost you can see goes up. But where we're going to go is the 90 strike for $23.50. So we're going to click on the ask to buy the option contract. Now, one option contract controls 100 shares of stock. So instead of paying this $23.50, you're really paying $2,350. However, if you buy 100 shares of stock, the cost is $95.50 times 100, or $9,550. So it's less than, it's almost 20% of what it would be to control the 100 shares of stock. So this is the leverage that you're utilizing. All right, so we've got this on. We're going to buy the 90 short or the 90 long call, and it's in the money right now because the stock price is $95. Now we're going to close this option chain, and then we are going to sell the 42 days to expiration, May 16th, short call option against it. So this time we're going to go to the call side. We're going to go outside the money. Let's go to the 105, and you can see 410 right here. We're going to click on the sell or the bid. Now, what that did, it just brought down our cost by $410. So this is something that we can collect $400 every month. So you can see that brought the cost down to under $2,000 to control these 100 shares of stock. So 400, that takes 5 months. 400 times 5 months is $2,000, and that covers the cost of the LEAPS option to control the 100 shares. So if you did this every month, in 6 months, you could control the 100 shares for free. And you make money in either direction. So that's the beauty. And you're going to make money from the 95 all the way up to the 105. So a 10% upside on the LEAPS. And as long as it stays under that 105, you keep that full $410. Let me show you one other thing. If we delete that, now, just like owning the stock outright, we can go to the curve mode here. This is what I love about this platform. And you can see as the stock price, that LEAPS goes up, you make money just like owning the stock outright. So again, we're going to go back. We're going to put on that short call in May at 105, sell that for 410, and we are at 1937, under $2,000. We hit review and send and place the trade. All right, guys, remember to hit like and subscribe down below. Download the free options workshop. Leave a comment, ask a question. Let me know, are you utilizing LEAPS and selling calls against them? And what stock are you doing it in? All right, thanks for watching. I'll see you in the next video.